Imagine taking $1, going into a time machine, going back to 1926, investing it in different investments, and then taking a look at the value of those investments at the end of the century. $1 invested in small company stocks in 1926 would have grown to $6,816.41 by the end of the century. A dollar invested in 1926 and invested in large company stocks would have grown to $1,775.34 by the end of the century. That same dollar invested in long-term government bonds would have grown to $59.70. Inflation would have taken that $1 and increased its fake value to $10.09. I say fake value because it wouldn't have bought any more for your household. A dollar invested in Treasury bills, on the other hand, would have grown to $17.48. But what about taking a buck and just cramming it in stocks? Well, it turns out that if you would have done that in 1926, by the end of the century, you'd have $8.8 million. If you would have just taken and stuffed it in bonds, that bond investment would have grown to $13,975. That same $1 investment in bills, in Treasury bills that is, would have grown to $4,455. In gold, a dollar would have grown to $14.67 based on the CPI. Based on the actual gold price, a dollar would have grown to $14.38. When we look at the return variability of large company stocks, we can see that the market will go through a couple of years of strong positive returns and then hammer down with a negative return. Also notice that sometimes those negative returns don't hammer down as hard. When that happens, the market's going through a bull market. The year that's negative is called a reaction. Remember always that the average length of a bull market in the United States is somewhere around 17 years. A lot of people are usually looking for a bad, big drop in the market after 4 or 5 strong rising years. That just isn't so, and you can see it right here in the large company stock data. Notice that the highest return here is somewhere between 50 and 60%. When we go and we take a look at small company stocks, the highest return is much higher, somewhere around 140%. Notice we get that same return variability pattern. Plus, we get a little deeper loss when we get losses, and we get that same pattern where we get a few years of good, strong, positive returns, and then we get hit with a negative return. Looking at long-term government bonds reveals a similar pattern. However, we have longer periods of positive returns, but we do occasionally get negative returns. This happens when you're invested in a bond portfolio and interest rates rise. That's because people can go out and get a higher return just buying new bonds, and they don't want to buy your bonds that have lower returns. That means that your bonds are going to get discounted. We'll talk more about that later in this course. When we look at Treasury bills, an extremely interesting pattern emerges, and that is that we don't see any negative returns whatsoever. If you look at that zero line, there's nothing below it. And that's exactly why we call Treasury bills risk-free investments. That's because you're always guaranteed to get 100% return of your initial investment. You may not get much of an interest on it, but you will get your investment back. Inflation is a very interesting picture as well. If we take a look at the beginning of the last century, we have periods of deflation. That's where the market shook up so much that prices of typical goods that you would buy for your household actually dropped in price. As we go into the 1940s and 1950s, we had periods of extremely high inflation, above 15%. This causes absolute havoc in the economy as well. Notice that in 1970s, we had periods of high inflation as well. Paul Volcker, who was the head of the Federal Reserve at the time going into the 80s, decided that he wanted to really cramp down on inflation. So he increased interest rates dramatically, which you'll see throughout the course. When we take a look at that period of 1980, interest rates went very, very high. That was done to basically push inflation down. And we can see that inflation has been relatively low, under 5%, throughout the 80s, throughout the 90s, and into the recent century.